So when you come to this fundamental grades, right? I mean, so first let's talk about how do we qualify the stocks. I mean, the stocks which pretty much like most people know, an IPO stocks. This is the initial public offering. When a company is making money when it is private, and it is good, is doing good for the customers, and its revenues are growing, and their profitability is going up. They need a lot of money to scale. Like if they want to become 10 times what they are right now as a private company. And typically, like when you get to the 300, $400, $500 million revenue, I mean, most of the private companies who has an intention to become a public company, that's the ideal sweet spot, and that doesn't mean that is the right. That is the number that they have to become an IPO, but that is the ideal profile of most of the IPO companies. I mean, once they are, and there are companies who go IPO at $100 million level, and there are companies which go at $1 billion level as well. But that is the ideal sweet spot. And if I were to invest in a company in an IPO, then at minimum they need to have that $500,000 revenue, and they should be a profitable company by then. So those are the my criteria of IPOs. Investing in the IPOs. Otherwise, I'm not interested at that moment. So that is pretty easy to see what stocks went IPO. And there are several. I mean, they come on CNBC, they come on Yahoo Finance, and everywhere. Like when they are IPO announcements. Of course, you can take a look at Delphin as well. We haven't made a lot of that news alerts as a public alerts yet, but we are working on towards that. And a lot of these IPO stocks, when they initially go at a $500,000 level, and they are not yet profitable, or they are very close to profitability, they seem to have a lot more expenses because they are recruiting more talent, and they are spending more on marketing, they are spending more on sales, and their customer acquisition cost is high, and you can't evaluate that company against a Walmart, which is already a stabilized company, and has already a presence across the United States almost every 5 months, once or every 5 months. And so we can't compare an IPO stock with a Walmart, which is a stabilized one, right? So because the numbers and the way Walmart is being run, which is a stabilized company, is going to be very different from a growth company, because their capital expense is going to be higher, sales expense is going to be higher, and talent acquisition will be higher, profitability will be low. But the future potential is what we look at. That's what the growth category means. And when we go to this income category, and once the growth, the companies go in a phase-wise. So they will initially go to the public IPO, and then they go into a growth phase. And once the growth phase erodes, I mean when you are $500 million company, companies can grow like at a 50% rate, and the next year could be a $750 million revenue. From a 500 to a 750 is much easier than $1 billion to $1.5 billion. I mean, once they get into $1 billion, then $1 billion to a 1.25 billion is a good growth. So likewise, when the company becomes about 100 billion, then 10% growth, and then adding 10 more billion onto the 100 billion is going to be much more difficult. So also at the same time, obviously, like when the companies are growing to that extent, in terms of adding more billions to the revenue, obviously over time, like 5 to 10 years period, like they start making profit, and they start accumulating profit also. So when they start accumulating profit, on the stock owners, the people who own the stocks, and they are the essentially the owners of the company, right? So it all depends on, even if you have one stock, you are a owner for that company, and for a small piece of the company. And there are major stockholders, like there are some institutions like own 5%, 7%, 10% of the company. So they start demanding either to reinvest the profits to propel the more growth, or to redistribute that profit to the stockholders, to the owners, in terms of dividends. and that those dividends can come in two forms. I mean, that can be a regular dividend, that can be a special dividend. Special dividend means I have excess money in my pocket. I'm going to do a one-time dividend. Don't expect me to do this all the time. I'm going to give $10 for every shareholder return back. If you have 1,000 shares, I'm going to send 1,000 into $10,000 like to you. So that's a simple equation, simple math, and there's no expectation that that will get repeated another time, unless there is a huge pile of cash accumulated, huge pile of profits and huge pile of cash accumulated. The companies don't do special dividends unless only in exceptions they do it. So other categories like in the regular dividend, that means they announce a portion of the profits will always come back to the stock owners in terms of a quarterly dividend or a monthly dividend. There are some ETFs which do monthly dividends, and there are more stocks like which do quarterly dividends. So if it is like $1 per share, and the expectation among the investor community is they have capability, they have a business model, and they have the financials that can sustain that dollar dividend distribution every quarter. So that's more of a commitment. So companies don't come and announce the dividends very easily. They have to make sure that that is a sustainable one, and they are committed to maintain that dollar number, whatever dollar number that they have, and that they can continue to redistribute for an indefinite period of time. They can't say like, okay, for the next 5 years we'll do this dividend, and after that we'll drop the dividend. So once you announce the dividend, then if there are a lot more companies keep increasing the dividend amount when they start making money and growing, and when everything is in line in what their goals are. But in terms of when it comes to there are companies who reduce the dividends also as well. So at a time like this where there's a lot of uncertainty, and during the earnings period when they come and they don't know how the rest of the 2020 is going to be and the rest of the 2021 is going to be, and of course now business models are evolving, and all the businesses are figuring out how to deliver their services to the customers. But still, we are seeing a revenue dip of at least about 15-20%. So if this continues long, this COVID scenario continues long, and it could hit profitability factors, and the dividends might have to be dropped, right? So the companies which drop dividend, that's a negative scenario for most of the companies. So the stock price will start going down. That's one of the reasons why the management want to delay the dividends, and they don't want to commit to a higher number. So we are working on grading models on measuring the quality of the dividend based on sustainability of the dividend. Is it enough percentage of the profitability? And there are some REIT, for example, the real estate investment trusts. They do a dividend of 18%, 30%, 40%. But those are the ones like which are not sustainable. That means if they get $100 profit today, they are ready to distribute that 40% dividend. Means they are giving back $40 because they don't know where to invest, and they can't make a better use of the money. So they decide to give it back to the shareholders for about 40%. So if in the next quarter, if the profits go down in a scenario like this, and a lot of those real estate investment trusts hold these retail malls and office spaces, and which is a high risk one. So they might come back and say, like, I'm not able to give the dividends this quarter or next quarter. Like we're going to reduce that dividend 40% to 10%, right? So if you are maintaining it at 3 or 5% or a 6% rate, there's a high chance that you can maintain that one. So that's what we measure. We measure the sustainability of the dividend, and is it good enough percentage for a percentage standpoint for a shareholder return as well, and historically how they have been performing in terms of their committed number. So is there a dividend surprises or in the downside? That's what this income models, income stocks will be categorized into A grade, B grade, and D grade stocks. When it comes to value, I mean, times like February, when the market, March, when the market dropped because of the COVID scenario, there are some stocks which went down from a value standpoint. I mean, meaning like there is a main street market, I mean, which is where the companies really operate their business models. For example, take Boeing. Boeing's main business is to sell planes and lease planes and make aircraft. Some of those defense equipment, whichever is needed by the defense, right? Those are the three major segments of the business for Boeing. So when during the COVID scenario, like the stock went down below $100, like, so that's the point, like where its revenue is much more greater than the market cap, and it reached a value position right at that moment. So if you want to buy the stock, that is you have a lot of margin of safety at that point. So from a value category standpoint, Boeing would be a great stock back then in March. So same way, safety is a combination of both income versus the value, and how much of a a consistent profitability measure that the company has been delivering. Meaning, like if there is a company which is beating the earnings of about for last 16 quarters or 20 quarters consecutively, that means across 4 or 5 years, there is a high probability that is more of a safe bet that they will beat the next earnings as well. So you can use this price to earnings ratio, on those type of stocks to predict what the stock is going to do, and rather, like if there is a stock which goes like one time beat, another time miss, one time beat, another time miss, and it happened about 20-30 times in the last up and down, like in the last 4 or 5 years, then that's not a safe stock that you can plan to invest based on those earnings. So the idea is, we are still working on these 4 different models on grading these stocks. For now, we will cover the growth stock, and the parameters. What we look at from the parameter standpoint is how the revenue is growing for that particular company. What is the trend of the revenue growth? Year over year growth, quarter over quarter growth, as well as like from an industry standpoint, is that industry suffering at this moment, or is that industry doing good? And if that company is beating the industry average, and is it on par with the industry, or is it delivering results better than the industry? And also, like from an operations profit standpoint, like do they have some obligations that they have to they are committed on a long-term basis, where we see an operational risk standpoint from a liquidity standpoint. For example, like the WeWork has a lot of operational commitments in terms of leasing real estate, like which are the office spaces are typically a 15-year or 10-year leases, and particularly depending on which area they open offices, and most of the areas where they would have to open the offices in the high quality business locations, wherein the lease terms are pretty tight. There's a very less chance to break the lease and not pay the entire rent amount for that landlord. So that's a little bit of high risk, even though there is a growth potential, but that is operationally that's a little bit more high risk. And another company like American Airlines has a lot of obligation on their books. In the next 12 months, they need a lot of cash, and whereas like they don't have enough cash that they are able to bring in to pay that enough money in the next 12 months. So likewise, when you need to funnel from some future growth, or when you want to acquire a company, or when be it a horizontal acquisition or a vertical acquisition, then you need a company that is generating a free cash flow. It means free cash flow is easily defined as: I got my revenue, I took all my costs, I got my profits, and I paid my taxes. Now I have some cash left over, and I don't know what to do. That's what the free cash flow means. Typically, this is the same free cash flow that has to go into the company for the future growth. Either within the company, or go and acquire a company which is doing a competition of yours, which is doing a very similar business, but they are catering to the different market space rather than you are in market A and they are in market B, and but the services are similar. Then you go and acquire that company. That way you expand the market. That's one way of doing it. The other way of doing it is they are in the market A. Both companies are in the market A, but they're doing different services. One is selling apples, and the other one is selling oranges. So that's a vertical acquisition. Like if you acquire, then you can sell both together, and you can bundle the deals. I mean, you have a deal power to bundle the services and give a better offering to the same market space. So that's called vertical acquisition. So also, when you are able to generate your growth from the free cash flow, that's a strong position rather than generating the future growth from bringing in more debt. So if you're adding more debt, then that's more risk. At the same time, if you have zero debt, that is you're not leveraging other people's money. So that is not good also. It's a slight mix of right debt structure. Like I mean, if you are about, in my view, somewhere around 30 to 60% from a value to a debt to equity standpoint, which is a right ideal mix. So if your value is $100, and if you have a debt around anywhere between 30 to under $60, then that's good. You're leveraging. You have some leverage, and you're using other people's money to grow the business, because if you are earning 10% and on the unlevered return, on the levered return will be much higher than what you are taking, because when you take debt, you're bringing outside money, and you are able to generate a free cash flow from that. Means you are able to pay the interest for that debt. On top of that, you are able to grow the business using that money, and you're able to generate much more higher profit. So this is a very broad category without going into the exact formulas and what we look at inside the engine. But based on these factors, and we categorize them into a bell curve format. For example, I mean, if you take any industry, I mean, be it a semiconductors or maybe a technology or a software or a retail industry or any industry, we take all the companies. I mean, maybe let's say like there are 100 companies in that industry, and we take what is the average strength of that industry, if you may say so, from a fundamental quality standpoint. So from a fundamental strength standpoint, if the fundamental strength comes, let's say like 500 points, and that's the average. And there are, if you divide those 100 companies and the strength into a bell curve format, so the 36%, 34.1%. Just give me a second. I'm going to change the color. Okay, so this 34% of the companies are doing good, better than average. This is the average line. So these are doing good, better than the average, and this side of it is doing lower, a little lesser than the average of the companies. But if you divide this in the bell curve, I mean, you look about one or two companies falling under this, less than 3 companies in 100 company. Less than 3 companies will be doing excellent, and they are the market leaders. They are the top dog, and they're the top cash cow company. They are the ones who was leading the entire industry and dragging that on in the up or down measures, right? So there will be 1 or 2 or 3 companies max, but there will be around 13 to 14 companies which are very strong companies in that category. So if there are 100 companies, this will be 3 companies, this will be 14 companies, and this will be 34 companies. So if you divide this 48 and 51, so roughly 50 companies will be doing better than average, 50 companies doing less than average. So if you divide this and categorize this way, this is what we call it as A grade stocks and B grade stocks and C grade stocks and D grade stocks. meaning the top performers in that quarter, the top 16 companies out of the 100 companies in the industry will be graded as A grade stocks, and the next 34 companies will be graded as B, and the next 34 will be graded as C, and the next 13 to 16 companies will be graded as D grade stocks. So D is underperformers, A is what we want to stay there. Just give me a second. It's been stuck for some reason. Any questions so far?
Yeah, Ashok, there was one in chat. It said you have a weighting formula to bring all metrics just discussed into one grade.
That's correct. We have a weighting formula on each of those measures. What I showed. Yeah, and once we get the weights around those formulas, what we do is we equate them. We try to normalize them to a 100-point scale, and that's how we are coming up with those different grades. So each one, I mean, there is a weighting difference. Which one need to be what weight? What is that we look for? So we can go to that slide again. See, there is a different weighting for the revenue growth formula. What is the optimal revenue growth? And also, like, if a company is doing 12% year-over-year growth versus 20% year-over-year growth, then of course the 20% company gets a better score in that particular parameter. But at the same time, if they're doing much more, if the industry is doing good and the company is not doing good, they get negative points as well. Like, so from an industry standpoint, like that, each one has its own value and the weight for each one, which is what we are. It's a proprietary weighting model. We are not disclosing that format. Okay, so what we expect in the A grade stocks is basically A grade stocks are going to be less volatile. If the market comes down, like how it happened in March, you can ask, like, I mean, did the A grade stocks go down? And the answer is yes, they did go down. But A grade stocks go down lesser than the D grade stocks. So the D grade stocks, if they went to around 80% down, and A grade stocks will be down around 30 to 40%, like usually 50% less than the D grade stocks. But at the same time, when the market turns back up, then the A grade stocks are the faster ones to, they take less number of days to recover back to their original position. And sometimes it could be a month, sometimes it could be days, sometimes it could be years, depending on what impacted. Back in 2008, yeah, probably took about a year to for the A grade stocks to recover. But we have seen like two V-shaped recoveries, and the recent one being COVID, and another one was in December 2018, right? So even though fundamentally I have a little, higher level of concern and fear, like trading buying stocks at this moment, because there is a big disparity between the fundamentals, what they are coming from, and what the stock market is doing. It's a little bit of runaway V-shaped recovery that happened, propelled by many factors, from a liquidity standpoint, from a Fed liquidity standpoint as well. But fundamentally, their companies are not yet that strong. So I will be a little more careful when I'm buying these stocks. That means, like, I will buy with proper hedges, but I wouldn't hesitate buying. Like, so, but But at this moment, I would definitely stay within the A grade or a maximum of a B grade stocks, and not touch any of the C grade and D grade stocks, because when the market is very high, then and when it starts falling, that's where like the D grade and C grade stocks get more impacted. So that's what we will see, like more volatile. And some people follow the contrarian model. Some people like the D grade stocks because of a reason. They are cheap, and they are $10 stocks, $15 stocks, $20 stocks. They're cheap in terms of relatively they are cheap than the I mean in the industry, as well as even when compared to themselves as well by their past prices. At the same time, they like it because a $10 stock becoming a $15 stock, which is 50% growth in good markets, is much easier than a $100 A grade $100 stock becoming a $150 stock. $100 stock could go to $120 stock, a 20% growth. But the smaller amount, when the dollar amount, lower dollar amounts, I mean, you might get a higher percentage of return. So it all depends on what kind of person are you from a trading risk standpoint, and on the way you measure your money growth. Are you measuring in terms of percentage growth of your portfolio, or percentage growth of your trading amount, or you're looking at a safe and less volatile and consistent growth? So it all depends on which one do you like.